What if I told you a single move by the US government just wiped out over $2.5 trillion from the market? And it might actually be part of a bigger plan. Right now we're watching one of the most aggressive economic strategies in modern history unfold, and it's shaking the global system from top to bottom. Tariffs are back, markets are crashing, and everyone's asking, is this a disaster or a reset? In this video I'm breaking down exactly what just happened, why it matters, and how it could impact everything from your wallet to the future of global power, including your stocks, crypto, and the value of the US dollar. I'll show you the real strategy behind the chaos, the surprising math behind the new tariffs, and a hidden theory that might explain what's really going on behind the scenes. And trust me, it's not what you think. Stick around to the end because I'm also sharing how I'm investing through this storm and what you can do right now to stay ahead, not behind. Let's get into it. On what's now called Freedom Day, a major move by President Trump triggered a financial meltdown. US markets collapsed, indexes sank fast, and investors panicked. Over $2.5 trillion in value vanished. New import taxes were announced, a 10% charge on all foreign goods. Some nations were hit harder, China at 34%, Vietnam at 46%, and Europe at 20%. These trade penalties mean the average American household could pay over $5,000 more in yearly expenses. The goal? Shift production back to the US, tighten supply chains, and reinforce national strength. Supporters say it's about security and restoring US industries. Critics warn of higher prices, trade conflicts, and a worldwide slowdown. But there's a possible twist. If the economy cools too much, the Federal Reserve may cut interest rates, helping the US refinance debt and lift markets. The result? A possible market boom, even if things look bad now. This shift could impact everything from your investments to the global financial system. Let's break down what it means for your future. When the US makes a major economic move, the entire world feels it. Right now, fear is spreading. Companies are cutting staff due to rising costs from new import taxes. Major businesses are spending big to try to avoid or reverse the policy. Markets are on edge and with uncertainty. Investors cannot plan ahead, causing huge swings. So what triggered all this? The new tariffs are extremely high, and critics say they were unfairly calculated. The US claimed these were equal rates, charging other countries the same they charge us, but that's not accurate. Most countries charge much lower rates. For example, China's actual tax on US goods is about 6 to 10%, not 67%. Vietnam was hit with 46%, but its own tariffs are far less. The US average tariff used to be 2.5%, while the world charged 5 to 10%. Now, America's charging 10 to 50%, much higher than before. So how are these numbers decided? A hidden formula was used, based on trade gaps, not matching tax rates. Example, US trade deficit with China, $295.4 billion. Imports from China, $439.9 billion. Result, 295.4 divided by 439.9 equals 67% tariff. That's how the new rates were set, and it's changing everything. The US used a simple formula to set tariffs. Trade gap divided by total imports, then divide by 2. Example, China's gap equals 67%, halved equals 34% tariff. Indonesia's gap equals 64%, halved equals 32% tariff. But here's the issue. These numbers don't reflect real-world taxes. Indonesia's actual rate is only about 8%, not 32%. Also, this method ignored services like tourism and finance, where the US usually exports more than it imports, a big oversight. Now many countries are facing 10 to 50% higher US tariffs, and some industries even more. So what does this mean? People fall into two groups. 1. Some say this strategy shows a poor understanding of global trade. 2. Others argue it's a bold move to push back against unfair practices, especially from countries like China. Critics and supporters agree this approach could have major consequences for both the US and global markets. Some argue that America should stop protecting its factories and let free trade work without limits. That would mean companies move jobs overseas, shutting down US plants and replacing workers earning decent wages and benefits with low-wage labor abroad, sometimes just cents per hour. Supporters of tariffs say the US, as a major economy, has the right to demand fair treatment from trade partners like China, including market access and protection of American ideas and technology. Strategic tariffs, if used wisely, could balance the system. Trump's push for this isn't new. He's talked about unfair trade for decades. He claims America has been taken advantage of, and tariffs are one way to stop the losses and start bringing in real income. But here's where it gets deeper. Some think tariffs are about more than just trade. This could be tied to interest rates, the Fed, and US debt. Here's the context. Interest rates are high to fight inflation. As a result, the US is paying nearly $1 trillion a year just in debt interest. That's money going to bondholders, not into the economy. For any leader trying to grow the economy and cut debt, high interest costs are a big problem. Now think about Trump's background. He built wealth by investing in property and using loans to expand. Some investors use the BRRRR method: buy, fix, lease, refinance, repeat. A system that only works when interest rates are low. Trump has said it himself, high borrowing costs stop people from building wealth. Now here's where tariffs come in. Yes, they raise prices, slow spending and hit markets hard, usually seen as negative. Even experts like Howard Lutnick agree, when countries raise import taxes on each other, it hurts everyone. But a weaker economy might have a hidden purpose: to force the Federal Reserve to cut rates. Lower interest rates could jumpstart the economy, make debt cheaper, help the US refinance its massive $9 trillion borrowing needs. This strategy may sound sneaky, but some believe it's intentional. Well-known investor Ray Dalio, founder of Bridgewater, supports the idea that tariffs act like special taxes. In his view, tariffs bring in money, and they protect local businesses. That could explain the bigger plan behind it all. Tariffs have a double effect. They cause higher prices in the country using them and cause lower prices in the countries targeted. But if the economy slows down enough, the Federal Reserve may be pushed to cut interest rates, and that changes everything. Investor Ray Dalio explains this clearly. Tariffs reduce global efficiency, limit investment, and can lead to stagflation, slow growth with high prices. That's bad globally, but could benefit the US if it forces the Fed to ease monetary policy. He also says tariffs can cut reliance on imports, strengthen local industry, and help fix imbalances in trade and national debt. Now add this: the US pays $1 trillion a year in interest on its debt. Trump's real estate experience taught him to refinance when rates are low. So the possible playbook: slow the economy, spark a rate cut, refinance the debt, bring manufacturing back, and rebalance trade. Dalio even said the world's financial and political systems are due for a reset, and bold actions like this may be part of that shift. His latest book, How Countries Go Broke. It sounds alarming, but it may be a survival strategy. Reduce dependence on other nations, restore US production, and keep the dollar strong as the world's top currency. Here's the main takeaway. We might not agree on how to fix the problems, but if the goal is improvement, we should be open to hearing different views. Yes, some parts of this strategy seem flawed, like confusing trade deficits with proper tariff logic, but it could also be part of a long-term game plan. That may be why Trump calls it Liberation Day, not just as a penalty to others, but as a way to reset the system. It's like a tough treatment, painful now, possibly helpful later. The truth? Only Trump knows how long this rough patch will last. Final message: stay the course, stay invested, long-term thinking wins. Thanks for watching. Drop your thoughts in the comments and don't forget to like, subscribe and come back. See you soon. This video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor, so always do your own research and consult a professional before making any investment decisions. Your journey to financial freedom continues, and I'm excited to be a part of it. Here's to your investing success. Profitable investing.